We have with us Neeraj Gaur, who's the director at Anand Rathi Share and Stock Brokers, joining us. Neeraj, good afternoon. So good to have you, talking to you for the very first time, and talking on a day when we are seeing a bit of a soft trade sentiment for the markets. We are already into the thick of the earnings season, some bit of a geopolitical tension snarling upon us. So how would you describe the sentiment so far?
Yeah. First of all, thanks and good afternoon, Lavisha. Thanks for having me in your show. There are two forces which are pulling the market in different directions. On one side, you've got the earnings, and we've off to a good start. The credit growth is pretty robust. It's actually at 18%, which is like a 2-year high. And manufacturing sector, which is fairly resilient. On the other side, we have got the collapse of the talks between US and Iran, right? And the crude is back to 90. So between these two forces, market is trying to align itself. I think this phase shall also pass. I'm pretty positive, looking at the earnings, how things are shaping up. I think if crude stays around 90, I mean equity markets can pretty much tolerate crude between 80 to $90. We should see a close to a double digit or kind of an earnings growth. In fact, if you look at that way, what was the problem in the market in last 2 years? The earnings growth had slipped to high single digits, right? Because your nominal GDP growth itself, which used to be 10% plus, came down slightly, short of 9% handle. If we have some moderate inflation, which we are having now, my sense is that we'll be back to 10.5% nominal growth this year, and the earnings growth will also be about 11-12%, right? So over next 9 months for March 27, I think if we just follow that earnings growth, that's the kind of the upside which I see in the markets, right? So I'm pretty much positive and constructive on the markets.
Okay, got it, got it. Neeraj, just when we were breathing a sigh of relief that now geopolitics have taken a back seat and finally markets can move on past this and focus on earnings, we have oil back above 88. Do you see any worse levels beyond this?
No, not really, right? You see, we have been at this situation before, and let's take a step back, right? We had earlier faced challenges of, Ukraine and Russia. Even, last year we had seen this challenge between Israel and Iran, right? And now we had seen this challenge, in March, April, and again we are seeing it that. So this is not the first time which market is seeing this, right? So market is getting used to these things. It's no longer like a one-off event. It's like become a condition in the markets to live with, right? So I don't think markets will continue to react to the same news multiple times if it is already reacted. As long as your crude is around $90, etc., I think market would live over it.
Okay, got it, got it. Okay, Neeraj, let's talk about what's happening in the global markets. We are seeing some bit of a sharp correction in all of the semiconductor stocks across Korea, Taiwan. How much of the recent weakness do you think is a part of profit booking after an exceptional run versus a genuine concern about future AI demand?
Yeah, absolutely. I think you have put it in a right way, right? These stocks have done wonderfully well. So, and they've fallen from the peak. So I would just say there's sort of a profit booking which has happened. I won't say that, still that there is a AI bubble which is deflating. We are still not there, right? If that recent happens, we'll see how it would impact, right? Because there's been a lot of spending these hyperscalers are doing on the AI infrastructure part, the data centers, and we'll have to see what is the return over capital employed for this. We'll see the IPO of Anthropic coming in. I don't know whether OpenAI comes in this year or the next year, but investors will start questioning these companies on kind of the returns on the capital they are employing, right? And then there is a possibility that there is a reset in this trade, or this takes a breather, which people are talking that could be positive, and India is being seen as an anti-AI trade. But I would still be very selective on IT space, right? So that would help, right? Instead of, investing a big amount of money just on the infrastructure, if people optimize the enterprises, optimize their spending more on the existing systems, that'll be positive for the service layer where Indian IT sits. But having said that, we all know that there is a deflation which is happening in the ID space, right? That deflation, which is more on your coding, your application development and all that space of roughly about 20-25% deflation, which has happened, right? that's already there, which is impacting. And you look, the stocks have corrected about 25-30%, and they would be like 14 15 times 1 year forward. But if you look at the US counterparts like Cognizant, Accenture, they are just in high single digits, so they're still at a significant premium to their global peers. I mean, they would obviously trade couple of notches above the US names, because in India, we're getting a lot of retail money into funds, and these are index stocks, right? But still the kind of the premium is still pretty high. So I would say a lot of that deflation is priced in, but not fully. There could be still time and price corrections. Having said that, couple of companies have been winning contracts well. They have their own internal levers to improve on margins. That would continue. But a broader sector tailwind, I think it'll happen when there is an increase in technology spend, which offsets the deflation which has happened because of AI. Let's say if the global Indian or the global IT outsourcing market is $1.3 trillion, and we have seen a deflation of about 200 to $50 billion, it's about a $1 trillion market. Can the disruption in technology take this amount further higher beyond even $1.3 trillion? That's a big question. And our companies would have lost some share into this coding, because of these different platforms coming in. And the LLMs have taken a good market share there. But we'll have to see whether in enterprise AI, these LLMs can take a good market share, or our service companies take a higher market share in enterprise AI. So that's a question which will come in the medium term. So I'm not saying, you shouldn't look at these companies. My view is keep evaluating. When you see a tailwind where the IT spending is increasing significantly, and you have a confidence in your companies that they'll be able to protect their market share into those streams, into enterprise spending, then bet selectively on those companies rather than buying, all the IT basket immediately. So
Okay.
that's my view, Lavisha, on the IT space.
Okay, Neeraj. Okay, got it, got it. So, if an investor is looking from a long-term horizon, say 4 to 5 years, so what is the kind of growth that they can anticipate from the Indian IT stocks, which are relatively inexpensive at the current moment?
Lavisha, honestly, nobody knows. Things are just panning out at the moment. These LNs are also, deploying engineers, buying some companies. So nobody knows. What we know of immediately 1 or 2 year outlook, which is like a very low single digit, right? Is still not going to a mid single digit kind of a growth. And if you are just growing, 1%, maybe a 2%, right? And you are trading at 14, 15 on a high growth and cash flow, still that trade is not very attractive, because that's still not a case for a re-rating, right? So I won't bat in for a 1 or 2%. So even today, if I have a 3 year view, I would rather wait out for a year and see, how the spending comes and when does it come. I won't like to be, let's say, 4 quarter early into the trade. You can be a quarter early, Lavisha, into the trade. So that's my view, So I won't say that even if you have a 4 year view, that you should just jump and buy these stocks.
Okay, got it, got it. Neeraj, you were earlier mentioning about the global trade reset. Do you expect Indian IT to benefit if indeed some of the global AI names consolidate?
So yeah, we were talking about the global tech reset, right? So there is a possibility, right? It may not be happening now, but let's say a year down the line, whereas that sort of a AI trade take a big breather, right? The technology is here to stay. So like we go back to the .com, right? All the technologies are here to stay, right? But we saw that the kind of the stock price appreciation had happened in those stocks, that takes a breather, right? So if that reset happens, right, there would be also liquidity and the capital allocation which is happening globally. So right now, all the liquidity and the capital allocation was more going to US than to Asian markets like Korea, etc. And even we saw some redemption happening in Korea, right? Because Korea is already corrected, right? About 20% plus, right? But that money is still not come to India, right? Might have gone to Japan and to US. So if there is that tax reset, which is happening, I think at some point of time, that part of that liquidity come back to India. It could come in from, Korea itself, and there is a reallocation between Asia itself, right? Or some incremental, we are just like 2.5, 3% of the global markets, right? So I think, we'll start seeing more inflows, or some flows, which we have already seen something like $1.5 billion, this month. So that will have help the Indian markets, because what we saw over last 2 years, that significant amount of selling, half of that was in Indian financial space. That's why you saw the banks valuations really coming to very attractive level. And then rest of that was between IT and other sectors. Some of the sectors were still always in positive territory, like your capital goods, etc. So there, I think, we are not seeing any chances of resetting. But this tech reset can possibly get us some more liquidity, coming in from global allocators. So until now, we have been just firing on the retail engine. So that would be the positive part of the tech reset, and not just about Indian IT stocks.
Okay, got it, got it. Let's shift focus from IT to some bit of what today's note from RBI said about FC and RB flows. That they've already attracted about $70 billion worth of inflows in just a month. Now, despite a good growth dollar inflow, much ahead of what the market was anticipating, we still have the rupee under pressure. So, your thoughts on the same?
Absolutely right. So, they've got, just within this month to date, they've got $17 billion in FCNR, and including your, external commercial borrowings and other foreign borrowings, that number is $30 billion, right? For the month, its estimate is will cross, about $25 billion. And there is a 3 months window, right? So the assumption which is standing today is that you'll get about $50 billion plus in FCNR and $10-15 billion more into your ECBs, and that's a good number. 60 to $65 billion aggregate FCNR and your other foreign borrowings, right? So I think that will take care of your balance of payments, right? If crude remains between 80 to 90. Now you look at the INR. I'm not a currency FX expert, but just like the broader contours, rupee was taking was consolidating. It had gone to 96 and came back to 94. With FCNR news, but again you saw that spike in the crude because of the crude stocks getting collapsed. So that is one of the driving factors. So that $50 billion will definitely help. But market is just trying to price in the uncertainty again, and the crude was breaking $90 just a day before, right? So that's the concern which is again pressuring, right? Because if it were to go up higher from here, then the benefit of FCNR can go away. But that's not my base case, right? We saw that there was an escalation, and again things were consolidating. So I think that this phase will also go away, and we should be back to our currency being a little bit more stable. And once, along with the tech reset, if the rupee is a little bit more stable, I think that's what will attract flows from the global guys.
Okay, got it, got it. How do you approach banking stocks? Then, we've had good outperformance already on the back of this news. Their earnings are out, and we can see some bit of a margin pressure that remains a concern across three major of the private lenders. So, do you expect it to remain the same in the next couple of quarters, or how should one approach it?
See, first of all, the biggest positive for me is that the credit growth being 18%, right? That's a 2 year high, right? Your manufacturing sector is pretty resilient. There has been an increase of corporate borrowings as well for working capital loans and other things as well, right? So that's the positive aspect, that credit growth is very, very good. Your asset quality for, most of the private banks is also very good. Couple of banks have seen some margin pressure because of the product mix and other things. One or two banks have been able to manage these things better and they stand out, right? While other have seen some, margin pressure of, 5 to 10 basis point. But I would, look beyond that. We'll have, what one of the challenges for the whole industry was there is a gap between your credit growth and deposit growth, which is persisting, right? But your FCNR, flows would help. Getting $50 to $60 billion, that will bridge the gap and help them on that, particularly the funding mix that will take care of their credit growth, right? And will protect the margins. So, I'm not too much worried about the margins. I think if the rates stay where they are, they'll, for the year in aggregate, they'll be doing pretty fine. And particularly, like if we see that there is a scenario that inflation persists and there is a case of rate hikes, then possibly there is a possibility that even margins can increase in the second half of the year if RBI gonna increase rates, let's say, from December onwards. In that scenario, we could have actually a increase in margin as well. That's not the base case as of now.
Okay, got it, got it. So, margin front, you're not that worried. So, already in the valuation wise, we're seeing that they are trading at reasonable price. So, would you own banks at the current juncture?
Yeah, I would definitely own banks, right? Because you look, if they are growing at 16 to 18%, protecting their margins for the year as a whole, maintaining asset quality. You look at OPEX to assets, right? These guys have been growing at a good pace, adding branches. You look at, they have not been adding headcount, right? So costs are being managed well. If you have a, 15, 16, 17% ROE, so you will definitely, you compound your returns with that kind of a number. There could be some re-rating if the margins were to expand. So I'm not building a case like what we had seen, a couple of years back that these guys were trading at like 3.5, 4x books value, right? Now, most of these private banks are between your 1.5 to 2x. The leader is at around 2x, right? So I'm not building a huge instance of re-rating out there, right? But you'll definitely compound with your ROE, and a possibility of a little bit of re-rating can also happen depending on the global flows coming back, because these FIs were selling these financials, right? And secondly, if the margins were to be better.
Okay, got it, got it. Apart from banks, another sector that has been spotlight today is just cement. We had good numbers from both Ultratech and JK Cement. Both of them have reported healthy volume growth. Do you think this is sustainable in the next couple of quarters?
See, other than the volume growth, what has been pulling the cement stock prices down had been the pressure on the cost front, right? Because of all this coke, etc., and energy dependence, right? There has been pressure on profitability for these guys, right? And also, they were not able to take price increases. Now we have monsoon. Let's see, once the festive season comes in, what kind of the pricing, these guys can take, right? That goes ultimately to their bottom line, right? The volumes and utilization, particularly for some of these leaders, is pretty high. So once you get a pricing lever, that flows to your bottom line, you'll start seeing that, there'll be a case to go a little bit overweight on these cement stocks in case the pricing were to come back.
Okay, got it, got it. Apart from banks, cement, any other sector that you're keenly watching out next?
I think, other than banks, there would be two pillars which are there for a medium term. One is on consumption, which would be not just your staples, but more your discretionary consumption, which has got premiumization. Your discretionary consumer would also include your automobiles, auto ancillaries, right? And manufacturing. And manufacturing is not just one theme, right? With the kind of the trade treaties we are having, with different countries, I think, and the rupee depreciation definitely helps the exporters. I think manufacturing space will do pretty well, and that space includes your auto ancillaries, capital goods, chemicals, even cement, building materials, general engineering companies. So I'm very positive on this space for next 4 to 5 years. Combined with discretionary consumption and manufacturing theme.
Okay, got it, got it. Neeraj, everybody I was speaking to, we've seen that realty stocks have gathered some bit of a momentum, and they were saying that this is coming in after a large bit of underperformance that all of these counters have seen. Do you see a similar case that there could be a re-rating down the line?
See, I mean, I don't have too much of investments in real estate, etc. And the stocks were very badly beaten down, so there have been already a good rebound onto that particular space. What is more important in this real estate is you look at how these guys allocate capital. They buy land, then they construct it, right? Your P&L and cash flows, you have to see both the things, and not just the P&L. So you have to really see how these companies over a period of time, are they allocating capital or they continue to buy a land at a higher price. Then there is a risk couple of years down the line, you're buying land today at a very elevated price, right? Your land prices have gone far higher than the flat prices. I have a place here in Bombay in Powai. I would have hardly seen, a 10% appreciation over last 2 years, right? The land prices have gone further, right? So I would be very cautious to look at real estate companies and advise people to see wherever they're buying, not just the P&L, but how are these guys, allocating capital today. That will determine the profitability they'll have, 3 years down the line in their projects.
Okay, got it. Just one last question before I let you go. Is there any risk in the markets that you feel that we are still have not priced in yet?
Yeah, so we touched on this briefly, right? So if the inflation persists, see, currently central banks are thinking that this disruption is temporary on the energy prices, etc., right? And you talk about the global banks or the Indian central bank, right? They're just watching how things pan out and they're watching the data. But let's say if this thing were to persist or last longer and the inflation persists, and they would start looking at increasing rates, and we are already, the global bond yields are at pretty high levels, right? Your 10-year 30 years in developed markets. If there is a further pressure because of inflation to take rates higher, I think then that's a concern, right? Because that increases cost of the capital, and that's a big driver of equity valuations, right? So if the yields were to go further higher from here, then there'll be a case of de-rating for global equity markets in general, not just specific to India.
Okay, got it, got it. All right, Neeraj, thank you. Wonderful conversation, but looking forward for to more such conversations ahead as well. But with that, we have to let you go. Thank you so much for your time and of course joining us.
Thank you, Lavisha. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.